An interesting update on some research that was done by CBRE. Thank you, Brad McGay, for this. This is a CBRE State of the U.S. Multifamily Market Update, Q3 2023, as you can read. And I just handpicked a few of the slides that seem relevant to my operations and what I'm seeking for the next multifamily syndication to offer to my investor group. So let's take a look at a few of these and see what's relevant for you. All right. So first of all, we have some of the information like the economic detail. I'm not an expert when it comes to that. I do respect those individuals that put this research together. But the main thing that I see here that jumps off the page to me is the 10-year treasury. So why is that? Well, when it comes to commercial financing, or in particular for financing through, say, agency debt, which is Fannie Mae or Freddie Mac, a multifamily specific loan product, they're typically going to be a spread of 200 basis points, sometimes as low as 150, maybe 250. Just depends on the size of the asset, the experience of the sponsor, the location of the asset, but somewhere around 200 basis points spread above the 10-year treasury is what you would expect to be quoted for a rate on a multifamily loan product today. So the interesting thing is the 10-year treasury was on the upswing for the greater part of the last year. Recently has come back down a little bit, 4.6% as of here, November 2023. And yeah, it's hovered around there. I haven't looked at it today, but anyway, what that does is that actually the reduction in the 10-year treasury has a direct impact on a reduced rate on the loan that I can get. My debt service or my principal and interest payment is therefore lower, and it might make buildings that were a little out of reach where what I could pay and what the seller wanted, there was too much of a bid-ask spread. Well, that spread could be narrowed. This is one of the ways to do that, where the treasury rates come down, your loan rates come down. Now your cash flow can increase and get you closer to where the seller wants to be. Maybe help some additional transactions come to fruition. So that's that slide. The next one here talks about rent growth in general, and you'll see some things that jump off the page here. You can see the dip 2021, that would be COVID, had an impact on rent growth temporarily, but then the incredible surge in rent growth for the balance of 2021 and 2022. So we were experiencing north of 10% rent growth for many of my personal assets. It was hard for me to keep up. It's just hard to believe. Certainly didn't believe it was sustainable. And as history will be the judge here, I mean, it certainly has already come down. Looking at rent of primary residence versus, this is just CBRE's general rent blend consensus, just a significant drop. And I've experienced that too. So for my existing assets, what I'm finding is that when leasing up a new space that becomes available, I'm not pushing rents as high as I was, say, a year ago compared to where they were. Now, the key is, though, where those rents were, because if the rents that you had in place are still trailing the market, there might be some upside. That's called loss to lease, how much below market rents you truly are. And when looking at an asset that might be for sale, that's one of the main aspects that I'm looking is what is the loss to lease? Even though rent growth is slowing, there might still be significant upside in rents based on how the current owner has operated that building. So, but in general, COVID dipped it post-COVID, or through COVID and post-COVID, it jumped up. It's now coming back down. Delinquency is just an interesting aspect. Now, this is how is this going to impact a property owner, a multifamily syndicator? Well, this will impact the residents and the financial situation they're in. So when you see delinquencies increasing, this is on different types of debt products, auto loans, credit cards, mortgage, and student loans. It was coming down for quite some time and now is creeping back up. Most of them, with the exception of student loans, but that might be because many of them are still in deferment. Actually, I have no idea, but I think some of them definitely are. I see applications that come in on my vacancies, and I still see some in deferment. But those that are not, credit cards, well, as interest rates have gone up, credit cards have increased their interest rates substantially. So auto loans are typically fixed rate, but might be going up with rates going up in general. But overall, you see a delinquency bump of about 200 to 300 basis points here, which is pretty substantial. So this, to me, highlights when I'm screening a prospective resident, I want to look carefully at their debt to income ratio. So just like when you're applying for a mortgage, they're going to look at what is your debt to income ratio. I mean, with the new mortgage payment factored in and your existing debt, if any, it might have a threshold of 40%, where they want your debt to be 40% or less of your overall gross income. I look at the same thing for tenants, and we'll look at a later slide that'll show your typical debt to income for a tenant. It might be closer to 30%. So it just depends on the location of the building, but I am paying close attention to, well, are there any debt products that are in deferment? Do they have $100,000 of student loan debt? What would the payment become if while they're living in the building, now they have student loan debt piled on top of their other debt? I want to factor that in as closely as possible to what reality would be down the road. So anyway, just a sign that it might be some struggles out there for some residents. Payroll or job gains. So job growth has slowed, still strong overall. Again, I'm not the expert economist, but I just see a general decline from 2022 to today. So one of the main things when you're looking at any area for investment is, well, what are the major demographics? Is there job growth, population growth, kind of go hand in hand typically? Is there diversity in employment or job, the types of jobs that are made available? Is it a heavy military area where if the US military goes out of business, you lose a big percentage of your resident pool? So you're looking at a diversity in employment, but in general, the overall jobs that are being made available might be on the decline. So pay close attention to where you might be investing. This is an interesting aspect, which kind of dips their toes into the residential market as well. But we're looking at the surplus or shortage of apartments and also single family homes. So no surprise to me as a realtor myself and as an investor that there's still a general shortage or pretty close to balance level of apartments being made available. Now, when you look closely under the hood, you might see brand new construction, new starts for multifamily having a much higher supply. But as far as existing garden style buildings, it's pretty close to neutral, where the absorption from the market or how quickly vacancies are being filled is still pretty quick to this day. Now, with single family homes, despite a rate increase, we're seeing a shortage of single family homes, so a shortage of supply. And from my perspective as a realtor, I think a lot of that hinges on a lot of sellers if they have mortgages on the property, are locked into really low rates. So it has to be a significant need to want to let go of a 2.75% interest rate to buy another house at, say, 6.75%. There has to be a life need, in my experience, whether there's a marriage, a divorce, a relocation. It could be someone that's moving into a retirement community. Whatever the case might be, we're really down to just fundamental sellers. Like, they have to sell, not that they want to sell. So upsizing is kind of low right now. Downsizing is kind of low right now. Just depends on the individual family's situation. But what we're seeing is a shortage of homes. That's what's keeping the pressure on single family home pricing still going up, at least in the suburban Philadelphia market, which is where I work. And for now, apartments are still pretty stable as far as demand. As far as the new construction side, the development side of multifamily, again, this is a broad brush for the nation. It's going to be different for specific locations. This is not a space I'm spending too much time in myself right now, but the key is the starts are coming down, which makes sense, especially with the debt service, which your loan interest going up so high. It makes it hard for you to make any sense financially of turning a return that you want when your debt service is so significantly high. I mean, think about it, when you break ground to when you complete the project, it might be 2 years, sometimes more. Might be variable rate debt, might be fixed, but then when you have to go refinance, now you're refinancing a much higher level, certainly what you didn't pro forma out or project out. So it's giving builders and developers the fundamentals aren't as attractive as they were a few years ago. Next slide talks about renewals. So again, I know as far as the assets that I own, the multifamily buildings that I own, what my renewal rate is still being absorbed quickly. I still have upside in some of my rents. I mean, just the tremendous increase in rental rates. I'm still trying to catch up to some extent, even though things are slowing down now. And as far as renewal conversion, so how many of your existing residents are choosing to stay versus go? Well, that's been the renewals have been increasing. This is way back to 2008 in the last recession of sorts. It dipped down during COVID, but kind of came back. So if you do a straight line, it's been generally steady, but look at the past half year or so, it's come down. So renewal rates are still above 50%. So what this impacts is when you're looking to purchase a building, or if you're a passive investor looking to invest in someone else's opportunity, you want to look closely at what their assumptions are. What kind of assumptions are they making for how many units are going to turn over any given year? So right now we're averaging about 45% turnover, 55% renewal as a nation as a whole. It's going to be different for each specific market and specific operator. Vacancy rate. This is going back to the last recession when it was north of 7%. It's come down all the way for the past year, all the way down to close to 2 or 3%. Now keep in mind, we have suburban is the light blue, urban is the dark blue, and now we've trended back up. So vacancies, at least in the short term, have been increasing. Again, you just want to be careful when you're investing in someone else's deal or you're the deal sponsor looking at investing yourself, is what is your vacancy assumption? So in the past, you might have gotten away with a lower vacancy assumption. You just want to be a little more conservative potentially going forward. Don't have a crystal ball, but again, the trends give us an indication of what the market response is to what's happening. As far as rent growth, no surprise, rent shot up significantly. Let's see, we have Florida, for some reason, led the way. Where I'm at here in the Northeast, Midwest and Northeast, a little more stability, but generally an increase about 10%, which is exactly what I experienced in my building, sometimes a little bit higher. And then now here we are in Q4 of 2023, we're back down below 5%. Again, as a whole, this is just a broad brush, but I would agree that this is what I'm experiencing. Now, they do project out for the next couple of years, staying at a typical historical average of 2 to 3%. So again, just on the pro forma or on the assumptions you're making of rent growth, you might have got away with 3 to 5% for a short period of time a couple of years ago. You certainly don't want to rely on that going forward. And to be careful as a limited partner, as a passive investor, definitely want to see what assumptions are being made for rent growth and for expense growth and make sure it seems reasonable. Getting back to another slide on rent growth. So this is interesting. This shows age of property in years. So brand new buildings. Think about it. A developer brings a new supply to the market. They want to maximize the rents as much as possible to get the return they want, because then when they go to sell or refinance, they can capitalize on all their hard work. Brand new building hits the market for the first few years, they've already maxed out. There's going to be a little bit of their growth is going to be limited. But it's interesting, as the building gets older, here we are, a 30-year building could get 3.5% increase on average, and a 15-year building could get closer to 3. So not a tremendous difference, but it just shows that if you are a syndicator or an investment buyer that are looking for properties, the older vintage doesn't necessarily mean poor rent growth. So it's a good sign. This only goes to 30 years. A lot of the stock that we have in suburban Philadelphia is older than that. I just found that to be an interesting tidbit. Rent growth versus mortgage payment. Let me go back to that. So again, there was something I had posted recently about the affordability of owning a home compared to renting, how that's fluctuated over the years. So during the recession in 08, 09, 07, in that time frame, the cost to own was higher than the cost to rent. As the recession kicked in and drug on for a while, the cost to own went down. Interest rates obviously have a huge part in this, because your interest rate went down during that time frame and kept going down, which kept the cost of ownership below the cost for renting. Renting was increasing at that relatively stable 2 to 3% rent growth, dipped briefly during COVID, had that significant rise through COVID and towards the tail end. Meanwhile, the cost to own a home has gone up substantially as interest rates hit nearly 8% at one point. They're down a little bit since then. But the delta here is going to keep a lot of people that might otherwise buy as tenants. And that's an interesting fact as an owner. Now, when will this fluctuate? Probably when rates come down, who knows? It's a massive difference, probably the largest, at least in this time frame, from 1996, where the cost of ownership is significantly higher than the cost to rent, which might keep the demand for your tenant base higher than it otherwise might be, at least for a short period of time. Household income growth versus rent growth. Basically, and there's even a slide that went back well beyond 2007, but in general, rent growth and median household income growth has been very close together, which makes sense. I mean, you can't arbitrarily increase rents forever. Otherwise, people are not going to be able to afford it. They're going to pick an alternative option for housing. But in general, since 2007, obviously things have gone down, things have gone up, but for the most part, they kind of follow the same cycle. The rent growth spiked up meteorically, but it's come back down. Now it's lower than household income. So I think we're finding that equilibrium, at least in this regard. Rent to income ratio. This is what I mentioned before. When screening an applicant, you want to take a close look at, well, this is just rent to income. I was mentioning debt to income, but same kind of concept. So rent to income on average for the nation is about 30%. So their rent makes up 30% of their gross income. It fluctuates certainly by area. So San Diego and Washington, D.C., some of the higher rent to income ratios. Meanwhile, Kansas City and Indianapolis, the Midwest markets, right in between Philadelphia, where I live, is right around 30.8%. So this is what you hear as a resident when you're marketing a vacancy might be, well, we want to be 2.5 or 3 times rent for gross income. 3 times gross rent and income basically gets you to about about 33%, right around where it is. So it makes sense that that is the average, and it makes sense that is what you should target as a landlord when filling your vacancies. Or if you have a property manager, make sure that you agree on the screening criteria, because the last thing you want to do, especially when you factor the debt into the equation, especially if there's student loan debt that's currently in deferment but might come due while they're living in your building, is for the benefit of the tenant and you as the owner, make sure that if they're not too sensitive to a life change, if their income drops, are they still going to be able to afford the rent, afford their debt, and afford the ability to live the life they want to live? Or if they are high in debt and their sensitivity then to any change in income or any change in anything else increasing as far as expenses, you want to have as much buffer as possible is the end of the day. But this just shows an average about 33 or 30%. All right, as far as investment dollars, this should be no surprise, really. The transaction volume in the commercial market, at least in the multifamily commercial market, has, in a sense, fallen off a ledge. I mean, and speaking to brokers, I hear about 50 to 70% of a decline in my area for commercial sales volume compared to the past 2 years. You can see 2021 was nearly $350 billion, came down to $300 billion in 2022. And year to date, 2023, we're not even at $100 billion. So this is as of Q3. Here we are. I'm recording this in December. That might have changed, but it is of no surprise that we're kind of a lot of people's pencils are down, bit of a lull in transaction activity. I think it a lot has to do with that bid-ask spread. As rates have gone up, my ability to pay the price that a seller wants based on where it could have been a year or two ago, it's just not there. It's very hard to make that work. But I do see that spread decreasing with time, and eventually transactions will happen. 10-year Treasury compared to multifamily cap rates. Sorry about that. All right, so the 10-year Treasury, like I said, was going down for many years. Cap rates started to come down with them. 10-year Treasury spiked up. Cap rates have now responded. So cap rates are going up or have gone up alongside the Treasury, which makes complete sense. Your debt service is higher. Your cap rate will increase. Remember, inverse relationship between cap rate and price or the value of the property. So if I'm looking at a building, if my debt service has gone up, I can't pay as much. The value comes down. That's what we're seeing here. Cap rates are going up, which means, or the values have come down, which means the cap rates have gone up. Inverse relationship. All right, as far as underwriting assumptions on average, so this is a good thing to compare it to how you're underwriting the buildings that you're looking at, or if you're a passive, how are the sponsors underwriting the investments that you're considering? So it just shows from 19 to 2023. We're looking at, all right, well, the target IRR has gone up, which makes sense because the cap rates have gone up. So the cap rates have gone up from at a low of 3.37 in April of 2022, kind of the peak was Q1 of that year, to now 4.92. So the going in cap rate, or the cap rate you're paying based on the in-place income, has gone up substantially, which means the price has come down a lot. The exit cap rate, so when you're laying out a pro forma or a projection of income and expenses, there might be an exit or a sale of the building, and there has to be an exit cap or a reversion cap rate, one and the same. And typically, you want to bump that exit or assume that exit cap rate will be higher than what your going in cap rate was. What we're seeing, though, is in reality that spread between the two is coming down. I think the expectation of the market is that, well, eventually the going in cap rates will plateau and start coming back down. So you don't want to price yourselves out by having an exit cap rate too high, too conservative, because then you won't be able to compete on the asset with the asset at hand, because you won't be able to pay the price that other buyers are willing to pay. Very sensitive topic, because I mean, you can really play with the numbers, and your IRR is directly tied to this because this impacts what the projected sales price will be. But the point is, you maybe not have to be as aggressive with the exit cap as you were, say, a year or two ago. Interesting. Couple more here in cap rates between garden style and mid-rise or high-rise buildings. The cap rate spread was much different several years ago. They pretty much tightened to where they're neck and neck. Garden style is a slightly higher cap rate than mid-rise and high-rise. And the final slide, cap rates by sector. So apartment, industrial, office, and retail, you can see they were all coming down for a while. So if you bought a building in 2010 and sold it in 2021, you look really darn smart, don't you? If you bought it in 2021 and now you think you need to sell in 2024, 2025, it's going to be tough, isn't it? Because your cap rates have gone up 2 to 3% in some cases. The projection, again, nobody has a crystal ball, but CBRE's crystal ball is, well, the cap rates will continue going up. Remember, the apartment here is what I'm focused on, which is this light blue. And by 2024, 2025, plateau and start coming back down. So the buying opportunity is in my eyes is now and then into next year, 2024. So I am actively bidding, still being conservative with my rent growth and expense growth and my exit cap, but this data is helpful for me to make the adjustments I can with more confidence so that when I bring an opportunity to my investors, it's not just guesswork. It's actually based with data and facts. All right, any questions on multifamily syndication? Feel free to visit my website, www.gotimberrun.com, gotimberrun.com. Feel free to set up a call on that website if you're interested in chatting more. I hope that was helpful. Take care.